Okay, so good evening to all. Now, today we are going to start the FM rapid revision batch for uh, FM planned for CA as well as CMA inter examinations. So this class is going to be in English. Um, I have I have conducted a separate class in Malayalam in the channel. Both languages, Malayalam as well as English, both will be uploaded in the YouTube channel itself soon. So, before we begin the session, we would like to introduce this is the first class of our new academy. So, being the first class, uh, we are going to introduce a new way, a variety way of the class. So, this is the first time I'm taking the class in English. Previously, I only used to take classes within Kerala. Now, since there are students who are non-Malayalis also, they have also entered our family. So I welcome you all into our academy. Before we begin, let me introduce wha- how is this revision batch going to be and what what is the purpose of this batch, like this batch. So this we are beginning the session with capital budgeting, that is investment decisions. That's the first chapter we are going to cover. And in this chapter will be a demo lecture. It's free of cost. You can watch it later soon in YouTube also. I will post this in YouTube. Don't worry. So in case you are not able to attend this live session, there's no problem for that. You can also check this out in our channel. So coming to the class, the chapter 7, investment decisions. So our revision batch, who all can watch this batch, who can all watch this revision, who are the students who can benefit from this revision? Usually when we talk about revisions, like students are like, yes, you must complete the entire syllabus, you have to finish all the topics, then only you can understand the revision. That's the usual case of revision. Why would we do revisions? Revision means revise the topics, like you must have previously studied. What if I didn't cover all the topics, or what if I haven't even started the topics? Those students might think this revision is not for me. So in this academy, in our approach, we are taking it to a different level, a variety level. So what about this batch is that in this revision series, any student who is who is willing to appear for CA intermediate attempts or CMA intermediate as attempts, anyone can watch this. Like how? One, those students who are freshly entered into the May 25 attempt, they're going to do their maiden attempt in May 25 inter. Like they have passed their foundation in September 2024, and they are going to write their exams in May for the first time. They can benefit from this revision. Those who have written their January exams, but they are not sure whether they would pass group 2, like especially FM is in group 2. In the case of CA, in the case of CMA, it is like June. They have the first case I told, they are going to appear in June 24 for June 25 attempt for the first time. In the case of CMA students, in CA it is May, CMA it is June. And the second one is that those who have attempted the January attempt in case of CA or December attempt in case of CMA, but they are not sure whether they would pass or not. So for those students, they can also benefit from this batch. And uh, like for the batch, whether the students have studied or not studied, that doesn't matter here in our batch. In our revision series, there is no difference as to whether you have studied the entire syllabus or you have just only completed a part of the syllabus or you had never even touched the syllabus. It doesn't matter at all. For those, we have prepared the notes. As I said, I would be providing handwritten notes. I have provided the notes in the WhatsApp group of our academy. So those students who have joined the session, they can open the WhatsApp group and open the notes, the PDF notes that I have shared in the group. Because yesterday when I was taking the Malayalam class, there was some errors regarding, like, we can't, it's not possible to simultaneously share the screen and record the screen at the same time. I'm not using the laptop. This is the notepad that I'm using. So in the notepad, it's very difficult to simultaneously record the screen and share the screen at the same time. So the English students today, those who have entered the live session, they can open the WhatsApp group. I've shared the PDF notes there. You can check it out. Okay, so where was I? Ah, yes. Those who have never studied or those who have studied, we have prepared the handwritten notes in such a manner that anyone can read and understand the notes. Like, if you have revised the entire syllabus, these notes are going to be very useful for connecting the topics that you have studied. Like, you have, especially in chapters like investment decisions, there are many concepts that you might feel confusing. So you can connect those topics together with these notes. If you are a person who has studied the entire syllabus, if you have a person you have who has not studied the entire thing, like studied some parts of the chapters or some topics and all, you can further enhance your understanding also with these notes. And if you are a person who has never ever started the FM syllabus or you haven't started this chapter in the context of this chapter, if you have never started this chapter, it's also not a problem at all. Because these notes are prepared in such a manner that for a person who has not started to study, they can use these notes as a preface of their learning. Like, before learning, like when you open a book, you would see a preface, like the introduction of a book, like what the book is about, like a story or a novel, whatever. You can see what the book is about. The crux of the book is written in a short form, like that. You can take these notes as a crux. These notes are prepared in such a manner that you can use this as a plan for your study, like how to approach this chapter. In that manner, you can visualize this revision also. So I hope this revision would be a benefit for you. So let's not delay any further. We can dive into this topic as soon as possible. We would try to cover it as quickly as possible. We are not going to lag further. Like, we are not going to extend it up to 1 hour or something. We'll like quickly revise the topics. So let's begin with chapter 7, investment decisions. So what do you mean by investment decisions? We know in financial management we have three major decisions, like financing decisions, investment decisions, as well as dividend decisions. So the first step is like the first step before investing decision. The first step is financing decisions. We all know the chapters that we have studied in financing decisions are cost of capital, leverages, and capital structure. These are the chapters that come under financing decisions. So what does financing decision tell about? It just tells about the source of funds, like how to procure funds, how to procure finance. Like, eh, we have to analyze the cost of capital. We know cost of capital. Those who have studied cost of capital, they can recollect. You can recollect other chapters also. FM is such a subject that you can recollect. You can interlink and recollect all the topics that you have studied in other chapters, and you can understand them in a sync. That's the benefit of FM. If you follow a proper approach, study approach for FM is so, like, FM is the best subject, I tell you. So for financing decisions, we know we procure funds like from debentures, from equity shares, from preference shares, from retained earnings, and we find the cost of capital and all, like KE, KP, KD, KR, whatsoever. Like, we procure funds in the best manner as to achieve two objectives. We have learned this in capital structure also. What are the two objectives? To increase the value of the firm as well as to decrease the KO, or the overall cost of capital, the WACC, weighted average cost of capital. You might have learned it in cost of capital. For these two objectives, we have to procure all these funds that we have learned in financing decisions. After financing decisions, next comes the step of investmenting decisions. Like first, you have to acquire the finance. We have done that. We have acquired finance from various sources. And next, what we should do is that we should invest these funds in the most prudential manner. Like these funds, what we have collected, we should find the best investing alternative so as to achieve the highest yields. Like the highest return should be availed. So investing decision is like a budgeting process. That's why we call it capital budgeting. Capital budgeting, we say the name capital budgeting is that it's like a budgeting process. You might have learned budgeting in costing, in cost and management accounting or management accounting. In the case of CMA students, you have a special paper for management accounting. In that, you would learn budgeting, like budgetary control and all. What is budgeting? You have to prepare a plan, a pre-plan, so as to how to expend and how to funds in the best manner to avoid wastages and all. We have learned that. So capital budgeting is that prepare a budgeting plan to forward for capital in the sense capital items. So investment decisions is like for long term, like for more than 1 year and all. It's not like working capital requirements is a very long, like more than 1 years, 2 years, 10 years. It's is for a long period. We foresee a very long period for such an investment. So it's nothing that you should identify the best. You have acquired so many funds from various sources. You have to apply those funds in the best manner so as you can get highest yields or highest returns. So it's a budgeting process for proper investment in long-term nature. So that's why we say capital budgeting. Like we have seen financing decisions, if they are called, if they are source of funds, capital budgeting or investment decisions are the application of funds, like source of funds and application of funds in fund flow statement. Like you have heard these two sources and application of funds in fund flow statement. For CMA students, there is fund flow statement. They have to learn it for management accounting. And for CA students also, you might have heard these terms in cash flow statement and all, AS3 and all. So capital budgeting is the proper application of funds to select the best investment opportunity. Like you have many machines like one, two, three. You have many plans. You have many alternatives to so as to buy which machine you should buy. So what factors should you consider? You should consider the most important fact is that it should yield the highest rate of return. Then only your funds utilized would be productive. So that's the motive of capital budgeting. And the purpose of capital budgeting is nothing. There are 3 points. As per the ISA module, I have written the 3 points. One is the heavy investment. You have to invest heavily, like thousands or crores of rupees. For in case of large companies like Ashok Leyland, MRF, all those automobile companies and all, Mahindra, they have to invest crores of rupees for infrastructure, for goods, for even raw materials. Like they use heavy materials. They have to manufacture automobiles. So that tons and tons of amount of steel, metal, tires and accessories and all, they have to invest crores of rupees. That's the main thing on capital budgeting is the investment is high, huge investment. Next is effect on long term. We have seen that capital goods and revenue goods. We have learned this in basic accounting. What is capital is like a period of more than 1 year. We know that in accounting, the basic principles on accounting and all, capital and revenue differentiation on we have studied. That's the same thing here. It is effect on a long term, that is more than 1 year. And the third, the most important factor is that it is an irreversible decision. That means you cannot reverse the decision taken. Once a decision is taken regarding to investment, you can't reverse it. Like you spend thousands and crores on a machine, and the next day you are saying, I don't want this machine, let's just cancel this and all. You can't say that. It's not a 10 rupee thing or a 500 rupee. It's not like a shirt. If you buy a shirt and you don't like it, you can return it online, or you can go to the store and return it. But it's not the case in a case of machines or investment requiring huge and huge amount of money. They might be legal contracts, they might be licensing terms in case of hazardous industries and all, like chemicals and all. They have to obtain huge license, and you have to like invest in licensing and all. So once you do that, it's very difficult to get paid. It's not difficult, it's impossible. You can't like just reverse your decision and all. So that's the main thing. It's irreversible decision. So this is the why this chapter. Like in our notes, we have provided a first page is like why should we learn this chapter. This is the most important thing that we should know in any subject, like in any subject, especially in practical subject like costing and FM. You have to understand why each and every chapter we are studying. Because it's just like if you plainly study a chapter, you can't understand anything. You just mug up all the formulas. So, to better understand the chapter, you should understand first why should we learn this chapter. So, investment decisions. Why are we learning it? That's the first page in the notes I have provided. I have written it in the most simplest manner as to why we should learn investing decisions. So, I hope you guys understood the theory part, the need of this chapter. If you understand this, we can further proceed smoothly with the formulas and all. So before moving on, I would like to ask whether it up till now is it clear? Okay. And about the pace of my uh, like talk, my class is like so fast, or is there any uh, unclarity and all? If there is anything, please inform. Is everything okay? Is my pay okay? It's okay. Thank you, Leah. So let's get into the next part, that is estimation of cash flows. So in our revision is like so concise. We are planning a very concise revision so as to revise all the topics that you have learned. So these notes are made in such a manner that it's just to like revise and just to reflect what you have learned, uh, because you might have all learned all the theories, all the concepts. You might have done a lot of questions. You might have learned the equations and all. That all you will do it. The most important part is that which how these terms or how these concepts are to be connected in a very meaningful and understandable manner in the brain. That's what is relevant here in our revision. So I would not like dive deep into the like how to like estimation of cash flows. You all would have done it. You all would have practiced it in your formulas, done many questions from NTP to NTPs, RTPs, and all. You might have done practice a lot of sums. So our motive is simple. We just need to uh, like approach for the best part of the exam. How to present well in the exam. How to like connect all the ideas, and at the time of the exam, how you spark it in the brain as quick and as fresh as possible. So that's our motive. So estimation of cash flows. This is one topic that you should know. Like in cases of in many problems, like you would have given so many long problems you would get. There are many adjustments and all. Like they won't give direct questions. Like they usually the direct questions is like in initial year you would invest, you have an outflow. in 5 consecutive years later you would have some inflows, you have to discount that and all. That are direct questions. Some indirect questions may ask regarding like there are some adjustments, you have to adjust depreciation, you have to adjust tax, you have to adjust like the replacement decisions and all. There are many things. So when you read the question, too much crammed information will make your brain like you will burst your brain. So the reason is that we can't understand the question properly, and the reason for that also is we can't like understand the concepts, like the difference in the concepts. There are many concepts in this chapter. In investment decisions, there are like so many concepts that are closely similar to each other. Like if you see one concept, you feel that this is the other one. If you see that one, you would feel vice versa and all. So the main problem is that we have to differentiate among them. So in estimation of cash flows, one thing that you have to understand while reading the question is that you have to, the first point is that you have to check whether it is a new project or a replacement decision. There are problems which test both things. Like some problems they might ask a new project, and some problems they might ask replacement decisions. So new project and replacements is a decision. The difference is simple. New project is like they will give a fresh project. You require a machine, and you have to find like the NPV or IRR or whatever the questionnaire the examiner asks you. You have to find that. The project is new and newly acquired funds are that you have to decide on buying a new machine. That's the new project. Whereas in the case of replacement decision, you already have a machine, like existing machine, and you have to replace it. So while replacing it, what factors should you consider? That you should understand. So when you get a question, you have to check whether it is a new project or a replacement decision. If it is a new project, we simply do it like we get the cash flows as we have to find cash flows. Now cash flow and profits are different. And that's one also another factor that we have to understand in the context of capital budgeting. In capital budgeting, the cash flows that we receive, the inflows that we receive, it's not part of profits, it's not the accounting profit, whereas it is cash flows. Like if you have understood cash flow statement, the logic behind cash flow statement, then this would also be easy to you. Like you have to like think the flows, the inflows in a cash basis, not the accrual basis. So you have to actually realize the cash in hand. How much cash would you receive? That's the main point here. So for and estimation of cash flows, like if the examiner directly gives you cash flows, there is nothing more to be done. You can directly write the amount. Whereas if the examiner gives you profit after tax, PAT or EAT, if that is given in the question, you have to do some adjustments. So what kind of adjustments should we do? We should add back the non-cash expenses like depreciation, amortization expenses and all. If there are any non-cash expenses, if there are any non-cash expenses, you should add back those non-cash expenses. Okay, then only you can get the cash flows. Like uh, the main part is that the students might make a mistake in exams. Like the examiner may give profit after tax, but students will directly write it as cash flows. That is wrong. If there are any non-cash expenses, amortization expense or depreciation or whatever, you should add back to get the actual cash realized. This is the same concept as we learn in AS3 cash flow statement. In net cash from operating activities, you will see you have to add back adjustments for non-cash items, add back depreciation. That's the first thing we'll write in net cash flow from operating activities. So that's the same logic here. If you understand it there, then this would also be easy. So that is about new project. Whereas in the case of replacement decision is nothing, as I've said, you have an existing machine, you already have a machine, you want to replace it, you have to change the machine. Then what, while taking such a decision, you only need to consider the marginal effect between the old and the new decision. That is, you have to compare between the yields of old and new investment. All the factors, all the marginal factors, all the differential factors between the old one and the new one. Like if there is any change in revenue, like the old one yields only 1 lakh per annum, but the new one yields 1 lakh 20,000. So only the effect of 20,000 is to be considered. So only take the marginal effect of all the items like of revenues or expenses. If there is any difference in expenses, that's also you need to consider, as well as depreciation, taxes, all. Only take the marginal effect of that thing. Okay. So replacement decision, that's about that. Check whether it is new or replacement decision and do that accordingly. And next, there are some factors, there are some adjustments that you might get implicitly in the questions. Like the questions might not tell you directly, they will give a long paragraph of unwanted statements and all. Between those statements, there will be some hidden adjustments like opportunity cost, working capital. These all, if such adjustments come, what we should do. So, if you refer to these notes, we have made it so simple. So, opportunity cost, one thing that they might give is opportunity cost. Like in their case, this usually arises in the case of replacement decisions, whereas in old, like suppose I had uh, an old machine, uh, and I want to replace it. But when I replace it, I might lose some benefit that I might have received in the old one. Like, like the old one, suppose I used it in the whatever thing, I might at that time during the usage of the old, I might rent some part of it, like some proceeds of it. I rent out and get some rental amount during the old one. But in the case of new, when I wanted to replace it, I lose this benefit that I had received in the old one. So if such opportunity costs arises, we know opportunity cost is the best cost sacrifice or forgot. So if such opportunity cost had existed in the old one, you have to consider that while doing the replacement decisions and all. And such opportunity cost should be treated as a cash outflow. Okay, and the same applies to working capital. Working capital requirements, like in the beginning and at the end. Working capital requirements usually occur in two stages, at the start and at the end. Like it's like the day-to-day funds that we require, like some petty expenses, some like current assets and all, settlement of current settlements and all. We require some like day-to-day cash. That is working capital. So at the beginning of the project, whatever, we when we require working capital or when we invest working capital at the beginning, that should be treated as a cash outflow. Like we invest such an amount at the beginning, that should be treated as a cash outflow at the beginning period. Whenever we invest working capital, we should treat it as a outflow. And during the time of release of working capital, release of working capital is usually done at the final stage, in the period. In the last period, when we release the working capital, like we invested it 5 years ago, now we want to take it back. At that stage, we should reverse this. Like the at the beginning, at the investment period, we treated it as an outflow. So vice versa, at the time of release, we should reverse it and treat it as an inflow at the last year, the final year period. Suppose the question didn't say such thing like we should release the working capital and all, still we have to assume that the working capital is released. And if there is any working capital invested, just given the question that so and so working capital is invested, if only the invested portion is given, still we have to assume that we have to release it at the end of the period, and there hence we have to treat it as an inflow. It's because the logic behind is that at the beginning we invest some funds, it's day to day, like current finance and all, so we don't keep it there for long. Usually after the end of our purpose or end of our project, we usually take it back. So is the same case in, if the question still didn't say, we have to assume that it is released. And while taking this assumption, it's better to provide a footnote at the end of the question, like end of the answer. After writing the answer, you can give a small footnote at the end that it is assumed that the working capital is released at the end of the period. We can give that. So whatever assumptions we take, uh, you have to inform it, we have to report it to ICA. That's the logic here. So whatever assumption we assume that the working capital is done like this, we write it as an adjustment. It applies to all the subjects like even tax and cost and everything. If you assume anything, just report it to ICA that we have assumed so and so. Okay, so that is about estimation of cash flows. We are saying we have to add back non-cash expense, non-cash items we have to adjust, and in case of replacement decisions we have to compare between the two and take the marginal effect. And so we have to like all this opportunity cost, working capital and all, we have to like adjust these in the following manner. So that is about estimation of cash flows. So, is the, anything? This is the second part of our revision. We have completed half of our revision so far. We have, like as I said at the beginning, we are going at a detailed, concise approach, so as to like you can get the topics as quick as possible. Like you might have studied it in previously, you might have covered these chapters. So when I like lengthen the revision series, it might become boring for you, because the purpose of a division is that you should reconnect and recollect, and you should interconnect all the topics and concepts that you know in this chapter in a very meaningful and concise manner. So all is anything unclear? I hope all is clear till now. Do you have any? Okay, okay. So if you have any like doubts, you can feel free to ask me. Like there is no barrier for communication between us. We are a family. So if there is any like you, if you have any opinion regarding, you can't like, if you can't hear, or you can't the audio is not good, or you can't understand a topic, you are free to unmute yourself and communicate. We should maintain a transparency in communication. That's beneficial for both of us. Okay, so till now we have discussed the cash flows and things. Now we are diving into the capital budgeting techniques, the most important part of this chapter itself. This chapter is mainly about these capital budgeting techniques. So these budgeting techniques are of two types: traditional and modern. We don't usually say modern. In some books they say modern. Is usually traditional is called non-discounting. Modern is called discounting. Usually in the books they give traditional and discounting techniques. So, what is the difference between traditional and modern techniques is that it's whether they use discounting techniques or not. Is in the sense that previously the previous methods they don't use to discount they didn't use discounting techniques. Discounting techniques means time value of money. They didn't apply time value of money in the past, so that's why traditional methods are called non-discounting. But in recent years, after some theories and after some ideologies evolved, the many thinkers thought we have to apply time value of money. So such methods are called discounting techniques. That's the difference. So before going into the discounting factors and all, let's just dive into a brief concept of time value of money. You might have studied in CA Foundation or CMA Foundation or CAT. You might have studied it uh, in previously, like time value of money, the interest factors and all. How this is relevant in FM? We know we have to multiply the discounting factor and all. And we might just do it blindly, like just as a sake of process and all. We just blindly mug it up. If you are a person who has not understand, didn't understand the top, like the logic behind the usage of time value of money, why we are multiplying the factor, like discounting factor, what is the meaning behind that? Here's the solution for you in our notes. If you refer these notes and later do and practice problems, it will be a cake for you. Okay, so time value of money. So time value of money, we know, like it's like a compound interest. Like if you deposit a certain sum of money, like it would get like it will get accumulated over the years. That's the time value of money. In case of banks and all, we know the compound interest. We compound the interest is compound upon the principal and the interest thereon. It is like it's like a recurring effect. You compound interest on the interested principal and so and so. So, in the sense of discounting factor, we all know in NPV and IRR we use the discounting factor. What the discounting factor is just nothing but somewhat like a inflation rate. That's the real like logic of discounting factor. You can think it this way. Uh, FM is like an open minded subject, like open ended subject. You can accounts and all. You can think in your own logic, and you can study in your own logic. If you are if you are sure and if you're confident in your logic, then you succeed. That's the theory behind some CA itself, the CA syllabus and all itself, tax and all, especially tax is like that. If you're sure in your logic, you would definitely succeed. So uh, uh, when I used to study, I use this logic. It's like an inflation rate. Like we can use it with an example. So suppose in year zero we have 1,000 rupees, and the discounting factor here is 10%. So it's like an inflation factor. Like in year one, this 1,000 rupees, 10% will increase and will become 1,100. 1,100 it will become, and in year two again 10% would increase upon 1,100. The 1,100 which is already uh, interest plus principal in year one, again 10% upon it, it will be in year two. So it will be 1,210, and so and so for year three and year four. So this is why I said discounting factor is like an inflation rate. Like 1,000 rupees as of now is equal to 1,464.1 4 years later, right? In year four, if you have 1,464.1, that is equivalent to the 1,000 rupees that you have now. That's why I said it is inflation rate. You just think it as inflation rate. It's just an inflation rate. So that's where the logic of PV and FV come into action. So present value and future value. So future value is like it's from the name itself you can understand. If you invest 1,000 rupees now, after 1 year or after 2 years, what is the amount future? What is the value that I would receive in future for this particular amount that I have now? What would be the value for it after a specific period of time? That is called future value. And if you reverse this logic, it's called present value. Like somewhere in the future, like in the fourth year or 4 years from now, if I have 1,464.1 rupees, what would be the present value as of now? It's a backward approach. If you like FV is a forward approach, PV is a backward approach. That I hope it's clear. And coming to the next part is that we can say from the formula 1,000 rupees plus 10. Like from year zero to year one, we have given a like a equation for the first year. For the first interest compounding, we have given 1,000 plus 10%. That in year zero we have 1,000, and in year one we increase 10%. So 1,000 plus 10%. We can write 1,000 plus 10% as 1,000 into 110%. Like 110% means 100%. Over and above 100%, we have 10 extra. That is 1,000 into 110%. If you like say you have 12% increase, so you have 12% increase, you can say 1,000 into 112%. If you have 20% increase, you can say 1,000 into 120%. If you have like 4% increase, you can say 1,000 into 104%. Like that way you can write it. Plus 10% is equal to into 110%, and that 110% we can write it as 1.1. Like if you type 110% in the calculator, it will show 1.1. So 1,000 into 1.1. So I hope you understood. I understood it till this far, and now it's where you would relate it to the process that you are doing. So 1000 into 1.1. So now let's compare year 0 and year 1. Like the first thing, we have 1000 into 1.1. If you get 1000 rupees in the first year, in currently sorry, not first year, year 0, in the first current year, you if you have 1000 rupees, next year you have 10% increase inflation, that's the discounting factor we see, into 1.1. In the next year you get 1100. So from year 1 to year 2, if we multiply 1.1, then how about we take a reverse approach? If we take a reverse approach from year 2 back to year 1, if we multiplied it in the reverse approach, we have to what simple divide it. So in finding the future value, we have to into 1.1, and so we have to, when doing present value, we have to find present value, we simply have to divide it. So from year 2 we have 1100. To find present value in the current period, we have to divide 1100 by 1.1. If you do that in a calculator, you would get 1000, which is the present value as of now. So this is why in the process of finding in PV and all, we divide 1 divided by 1.1. Then we press the equal button a number of times depending on the number of years and all. So 1 divided by 1.1. Now I hope you understand why we are doing that in the calculator. It's because to find from now to the next period, we have to multiply the number over and over again. So in the case of finding present value is nothing but the reverse process of future value. In future value, if we have to multiply, then in finding present value, you have to divide it. So that's why we divide 1.1 over and over again depending on the number of years. If it's 2 years, you have to divide it 2 times. That's why you press it the equal sign 2 times. Like if it's 3, we have to do it 3 times, that and so on and so on. So that's the concept of time value of money. Now we shall dive into the techniques of capital budgeting. You know the techniques, it is traditional and discounted. So we have said that, and in traditional we have 3 methods, that is payback method, payback reciprocal, and ARR method. So payback method, it's nothing but the number of the payback period is just the simple logic is that in each of the formulas, I hope you have, like if you are a person who has studied the formulas, you would have definitely learned the formulas and done many problems based on these formulas. So here, as a rapid revision, I would like to emphasize on the concept behind each and every formula, and why the formula is conducted, what's the motive behind the formula. If you know this and later do problems and study it once more, you'll be able to crack it easily. So payback period is nothing, it's just to find at which year, at which time period the investment that you have put in is redeemed back. So like suppose you put 1 lakh, suppose you invest 1 lakh, you invest 1 lakh, uh, uh, in the initial investment is 1 lakh, you have returns for 20,000 returns. You for 5 years, you invest it for a period of 5 years, and each year you get 20,000. So by the end of the 5th year you would get back 1 lakh. So that is the payback period, at which point of time you will receive all the investment that you have put in. At what period you will redeem back all your investment. So that's what the formula is about. There's 2 formulas on basis of that. If the cash flow is constant and if the cash flow is non-constant. Okay, if the cash flow is constant, the payback formula is investment divided by annual cash flow. So as I said, like you have invested 1 lakh. Each year, the inflow that you receive is 20,000. So at what period you would fully receive back the 1 lakh? That's the payback that you receive. Like we have heard of cashback in the case of Google payments and all. We have heard cashback. Like when we pay something, when we get back the money. Similarly, payback is the same sort of thing. You invest an amount, at what point you would get back the entire investment. So 1 lakh, if you get 20,000 each year for an investment of 1 lakh, after you will get back the 1 lakh in 5 years. That's the simple logic. And if the cash flow is not constant, this can you can only use the division formula, investment by annual cash flow. You can only use it if the cash flow is constant. If the cash flow is not constant, you cannot do that, because uh, you cannot divide, because all the years it's not uniform. So for that you have to do a cumulative approach. Like you have to add the thing like 20,000, 30,000, 60,000. You have many, the inflows are of various amounts. So you have to find the cumulative point, and at what point you receive the initial investment. Like in our example, we find 1 lakh. At what point of the cumulative you find, at what point there is 1 lakh? Suppose the 1 lakh lies between like the second and third year. Like the second year, the cumulative is 90, but the third year you get 1 lakh 10,000. So 1 lakh is amount between 90 and 1 lakh 10,000. So it infers that the the initial investment of 1 lakh is redeemed between the second and third year. That's why you use a interpolation formula. This is like you have studied in 11th standard or 12th standard, as well as CA foundation also, statistics, like frequency distribution and all. There are problems like that, like cumulative frequency. You might have studied. It's the same logic. So that's the payback period. Payback reciprocal. Now, payback reciprocal is nothing, it's just a reciprocal of the payback period. If you get payback period, like in the example that we discussed, payback period is like 5, 1 lakh divided by 20,000, it's 5. So payback reciprocal is just 1 divided by 5. That is 20%. Like it's just telling what's the percentage of the payback that you are receiving each year. That's just the logic behind payback reciprocal is like 1 divided by that payback. And next is accounting rate of return. Accounting rate of return is like you might have studied return on investment, like the ratios and all financial ratios. If you have covered, might have seen like return on investment, like the return divided by capital employed or investment. You might have heard this formula. So accounting rate of return is similar. It's just that in ARR method, one thing that we need to focus, we need to like give emphasis on is that we should not take cash flows here. Instead, we should take accounting profits or net profit. The usual thing that we do in accounts, in accountancy, in the accounting paper, we find net profit and all. That is the thing that we have to take here. In all the other cases, we have to take cash flows. As I said earlier, we have to add back all the non-cash items. You have to find the cash effect of the cash flows. But in ARR method, it's simply on the basis of accounting profit. So average net profit divided by investment. The only thing that we have to uh, be careful about is we have to. This is the accrual basis concept. We have to take accounting profit. So if there is like cash flows, you have to less depreciation and take it here. Okay, so that is about traditional techniques. And now discounted techniques. So discounted techniques are like the most confusing part of capital budgeting, the most tedious part of capital budgeting, where you have long problems and all. Usually the problems, short questions will come from discounted, like NPV, IRR, modified IRR, discounted payback, and profitability index. So before we shall first discuss about discounted payback period. Then we can dive into the other topics, okay? Because discounted payback period is nothing but the payback period that we have done here. In traditional method, we have discussed the payback period. If you This is just a simple thing without discounting. Discounted techniques are just that in the sense that we have to apply time value of money concept. We have to discount the cash flows into the present value. So in payback period, usually we just divide and all, or we just find the cumulative approach. But in case of discounted payback period, the difference is just that we have to apply the time value of money concept. We have to discount the cash flows. We have to find the PV of the cash flows in the payback period method. That's all. In the payback period method, if you find discounting and all, that's nothing but discounted payback period. So there is nothing more to explain about discounted payback period. And coming to the rest of the topics, NPV, profitability, IRR, there is MIRR also. I have forgotten to include it in the notes, but in the next page I have included it. In the chart I forgot to include. So these topics, like the most, like students find very difficult thing students face is that they get confused in the questions as to whether they should adopt NPV or IRR or MIRR. All these look so similar. Eh, it's like a very confusing part as to what method you should apply. So for that we have a solution in the fourth page of our note. In this page, I have prepared in such a manner that if you understand the logic behind each and every method, there is no sort of confusion. All these methods, as I said earlier, apart from the discounted payback period, NPV, profitability index, IRR, modified IRR, all are interrelated. It's just that we have to like prepare a mind voice. We have to follow a mental approach, a systematic path as in our thinking. If you follow as I say, I guarantee you have no sort of confusion as to applying the method. So beginning with the NPV method, the most popular, the time favorite method of discounting method of FF. So NPV method, we know NPV is a net present value. That is nothing but the present value that we use to find. We find the PV of the cash flows using discounting factors and all. So the logic is that we are not going to detail discuss the methods as to how to do it. I hope that you have understood the problems, you have done problems, you have attended lectures and all, you have done questions, you will be familiar with the concept, with the like the formula and the problems and all. And if you're a person who is studying this for the first time, it's better that you read this chart first. You understand this logic, the mental path that I'm going to share. After this, if you're going to study this chapter, it will be also be easy for you. So whether you have studied this chapter or whether you have not studied this chapter, both people will benefit these notes. Okay, so NPV method is like, we know the formula. It's like the net effect between the inflows and outflows, like as we do in cash flow statement and all. Like if you get inflow and you get outflow, the net effect, whether it's a profit or loss, it's just a basic profit loss thinking. That's all. There's nothing more to worry. We have to first discount all the cash flows, and we have to find like the present value, like whether it is inflows and outflows, we have to discount it. And you have to find the net effect, like PV of all the net cash inflows minus PV of net cash outflows, like inflows minus outflows, like income minus expense. That's all. The simple logic is that you find the inflows minus outflow, or the PV factored inflows and outflows, and the net effect. If it's a, like usually in accounting we say, if the income is more than expense we get profit, if the expense are more than income we get loss. Similarly, that if inflows are greater than outflows, surely this will be a positive figure. The number would be more than zero. It will be a positive number. So if NPV is greater than zero, we accept it. Like if it's a profit, we go on with it. We put a thumbs up sign. Whereas if it's a negative number, like if the outflows are more than inflows, like when you minus, you get a negative figure, obviously. So that means a loss. In the context of accounting, we will say there is a loss. So similarly, if the NPV is less than zero, it means if it's a loss, we will reject the project. It will be a thumbs down. That's all. If it's a profit, find the net effect. If it's a profit, we go on with it. If it's a loss, we reject it. That's all. So NPV method. If we understand NPV method, then profitability index method is nothing but a fraction format of NPV method. It's the same thing. There is nothing new or nothing different. Everything is same. What we understand in NPV, the same thing is understood in PI. It's just that instead of the horizontal statement like net cash inflow minus outflow, we write it in a statement format. This one we write it in a fraction format. So it's just we write it in a fraction. So inflows in the numerator, outflows in the denominator. PV of net inflows divided by PV of net outflow. So how is the the acceptance decision making? How is it here? If the PI is greater than 1, we accept it. PI is less than 1, reject it. Obviously, because in NPV we said profit or loss, but that's because we subtract it, so we get a positive figure or negative figure. Whereas here we understand it as a fraction. In fraction, if we say if inflows are greater than outflows, we know it's a profit. So when inflows are greater than outflows, like when we write it in a fraction, if the numerator is greater than the denominator, when we find it in the calculator and all, we will get 1 point something. It is always greater than 1. If the numerator is more than the denominator, surely the answer will be greater than 1. That's the indicator. So if the PI is greater than 1, it means profit. Inflows are greater than outflow, it's a profit. So if it's greater than 1, we'll accept it. Whereas if it's vice versa, if outflows are more than inflow, like if outflows, the denominator is greater than the numerator, we'll get a loss because mm, if the denominator is greater than numerator, if we find out in the calculator, it will never touch 1. It will always be less than 1. 0 point something, 0 point, it will never touch 1. So if PI is less than 1, that means if the outflows are greater than inflows, the denominator is large, so the answer will be less than 1. So in that case, it's a loss because the outflows are greater. So that's a loss, so we reject it. So that's all in the case of NPV as well as PI. Now the next thing is IRR method. So IRR method and NPV method, we might get confused as to what to do. Like if those who have sufficient practice in doing sums, they might get the trick. But like if like you have not done so much problems, you have not practiced so much problems, you might feel very confused. So apart from doing problems, if you understand a simple trick, there is just one thing that you need to understand. If you understand it, it's all good. So in NPV method, in IRR method, it's just that we have to find the break-even point of an NPV. So NPV, we know if it's greater than 0 or less than 0, we have to accept or reject, like that. So like in costing, you might have studied marginal costing. If you're appearing for group 2 along with FM, you will be studying costing, of course. So in costing, you had studied marginal costing. There you'll find break-even point. Remember, break-even point is that for this particular amount of sales, or depending upon the question, like how much sales should I do to attain the break-even point? How much units is the break-even point? Like that. What is break-even point? In simple costing language or accounting language, break-even point is just like it's a no profit, no loss point. Whether there is no gain or no loss, the result is 0 at equilibrium. In economics also, in plus 2 economics and all, 12th economics, 12th standard and all, you might have studied economics, the demand and supply market equilibrium and all. So that is the break-even point. Break-even point, there is no profit, no loss. So if we find the break-even point approach in NPV, that is the IRR method. So in IRR method is like you have to find such a discount rate at which the NPV is 0. Like we have done this in uh, marginal costing. Like at what point of sales, like how much sales should I conduct, or how many units should I sell so that I attain at the break even point. Similarly, at what discount rate should I provide so that the NPV is 0? That is the IRR method. So net here, net cash flows equal to net cash outflow. Where the balance strikes, that point I have to find. So that is the break-even point in NPV. So the steps in conducting the break-even point, you might have done it in problems and all. So first you have to conduct a trial and error method with two rates and find the NPV at both rates. Like you have to find a lower rate and a higher rate such that the equilibrium point the 0 point should lie in between. You have to find 2 points, and in between that the 0 point should come, like the equilibrium point, the NPV equal to 0 should come in between these 2 points. So it's better to take 2 points such that one gives a positive NPV, the other gives a negative NPV. So if the more you increase the discount rate, the lesser the NPV. So if you increase the discount rate higher and higher, the NPV will reduce. So first take a lower rate. At that, the NPV should give positive. And if you take another rate, the NPV should be negative. It implies that among these 2 points, between these 2 points, the 0 point should come. Okay, we have L and H. So that's the formula, the interpolation formula. And once you get the 2 points, you use this formula L plus NPVL by NPVL minus NPVH into H minus L. So the thing is that between, like, say for example, I took 10% as the first, then I got 1,000 rupees NPV. But when I took 15, the NPV I got is minus 1,000. So between these two lies the 0 point. So the implication of this is that my IRR rate should lie between 10% and 15%. So that's the formula we have provided here, IRR, the interpolation formula. You must have tried out, you would have definitely tried out problems regarding this. Here I have explained why we take 2 points. Like if we do it like blindly without any thinking or logic, we would lose marks, we would be careless, we make mistakes. So we should know, like, for every subject, be it accounts or FM or whatever, for every, like, when we study any topic, we should know the reason behind that, why we are studying that, for what purpose we are studying that, where should we apply the thing that we have studied. We have to know that. So these 2 points, as I said, we have to find the zero between. That's why we take two positive and negative AP and apply it here. So I hope you understand that it's IRR. And now coming to MIRR, there's one more thing, modified internal rate of return, or you can say terminal value method. So this is it's somewhat very similar to IRR. So many people get confused between IRR and MIRR. It's just that in IRR, you just find the break-even point. But the cash flows we are doing, like NPV and all, we are just like, we take that cash flow for that particular year. That's all. But later, some thinkers, some management thinkers, like financial analysts and all, they have developed a concept that, if it's okay, you can take a cash flow for that particular year, but when we invest the cash flow for more years, like if you have a cash inflow in this year, you can reinvest that inflow till the end of the period. So why not invest it so that it could be more profitable? That's the thing. So if you reinvest this amount, like each year's cash flow, if you reinvest it, it's nothing but the MIRR method. It's similar to IRR, but it's just that in each year, the cash flows in each year are reinvested till the end of the project. So I have given a small sample table. Assume the discount factor is 10%. So in year one, we get a cash flow. In all the years, we get different cash flows. So in year one, we get a cash flow. If we take the IRR approach, we just take each cash flow for that particular year. That's all. So we just discount it for that particular year and just find the NPV and not in the NPV method or whatever. We just do that. But in MIRR, the concept is that in year one, I have a cash flow. I received it in 1 year. The project is 5 years. So I have still 4 more years. So I thought, why not reinvest this amount which I receive now till the end of the period? Every year I will do that. So in the first, what amount I get in the first year, I would reinvest it for 4 more years. Like each year I have to invest till the end of the period. So in year one, my inflow will be reinvested for 4 more years. So that's why we are not just finding the present value factor, we are finding the present value annuity factor, PVAF, right? The cumulative present value factor. So the annuity factor. So CF into 1.1. Here's the 10%. So CF into 1.1 raised to 4. Because in one first year, there are 4 more years to go. We have to reinvest it for 4 more years. So that's why CF into the PVAF factor for 1.1 raised to 4. Similarly, in year 2, the cash flow, whatever I received in the second year, till my goal is the fifth year, the last year. So from the second year to the fifth year, I still have 3 more years. So what I receive in the second year, I will reinvest it for 3 more years. So the PVA factor is 1.1 raised to 3. We have to multiply it with the cash flow pertaining to year 2. Similarly, in year 3, we have 2 more years, and year 4, we have 1 more year. And in year 5, in the last year, I invested for 0 more years because I get an inflow in year 5, and at the end of the year, I have to cease the project. So, can I reinvest it? No, I cannot reinvest because there is no further period for reinvesting. So, whatever I receive in year 5, that amount itself is closed at the end of the project. So that's why if we look in the concept of this, the logic of this, we reinvest it for 0 more years. So CF into 1.1 raised to 0. 1.1 raised to 0. Anything that is raised to 0 is 1. We have learned it in CA Foundation, CMA, basic mathematics and all. We have learned it. A raised to 0 is 1. So CF into 1.1 raised to 0 is CF into 1. That is CF. That's what we have told. The amount that we have received in the last year itself, we have to cease the project in that same year itself. So whatever I receive, we can't further invest. So we just take that amount as it is. So that is about MIRR. I will just tell a brief thing about this, the discounted thing. We know NPV, the net effect between inflows and outflows that are discounted. So I find if there is profit, we accept it. If it's a loss, we reject it. In NPV, if we take it as a fraction format, like a ratio format, a proportion format, that is nothing but PI method. Similarly, like if inflows are greater, we get profit. So the denominator greater than 1 and vice versa. So we decide accordingly. And then it's IRR method. IRR method is nothing but we find the break-even point of the NPV. In NPV, whatever the break-even point is, we are like finding the break-even analysis of NPV. We can say it that way. And in marginal costing and all, we find such a point that there is no profit, no loss for this amount of sale. That's similarly for a particular discount rate. The net inflows and outflows should be tallied, should strike off. I mean the whatever discount rate such that the NPV is 0. We are finding that using the interpolation formula with these steps. And in IRR, just assume each cash flow invested that pertaining year. If we reinvest the amount till the end of the project, that is nothing but MIRR. Okay, so till now we have completed the entire investment decisions. We have taken 1 hour. We have expected. I thought I would complete it sooner, but we have taken 1 hour. but nonetheless, we have explained all the concepts in a very concise manner and in the best manner. I feel that I have explained all these topics in the most time saving, concise manner and in the most understandable manner. So, till now, is everything clear? Okay.